Whenever there is a geopolitical conflict, energy stocks spike. Everyone rushes to buy oil. Then the news cycle ends, prices drop, and amateur investors lose money. You cannot treat energy like a short-term gamble. You need to understand the mechanics of the supply chain. There are three distinct ways to invest in energy. The cyclical giants, traditional oil and gas. The hype, clean energy. The dividend machine, the midstream pipelines. Today, we are going to choose the best ETF from each strategy, then simulate a 20-year horizon to see which one is a wealth trap, and which one pays you reliable cash flow regardless of who is fighting. First, the cyclical giants, XLE. This is traditional oil and gas. When oil prices spike, these companies print cash. When oil crashes, they bleed. It is a roller coaster. You are buying a highly concentrated basket of just 22 companies. The top 10 make up a massive 75% of the fund, completely dominated by heavyweights like Exxon and Chevron. It started back in 1998, so it has survived multiple market crashes, earning a solid 4-star Morningstar rating. The expense ratio is a tiny 0.08%. It pays a 2.44% dividend yield quarterly. The DPS CAGR sits at 4.18%, and the price return CAGR is 6.75%. It is solid, but it depends entirely on the price of a barrel of oil. Next, the hype, ICLN. Everyone wants to invest in the future, wind, solar, and green infrastructure. But investing in a trend does not guarantee a profit. This is a broader basket of 100 companies, with the top 10 making up 50% of the weight, including names like NextPower and Bloom Energy. It launched in 2008 and charges a 0.39% expense ratio. It pays a tiny, semi-annual 1.47% yield. The DPS CAGR is barely moving at 1.44%, while the price return CAGR sits at 7.36%. You are paying a premium for a trend, but the cash flow is practically non-existent. Finally, the dividend machine, AMLP. This is the infrastructure, pipelines and storage tanks. They don't care if oil is 50 or 100. They operate like toll roads, charging a fee based on the volume flowing through the pipes. It holds just 15 companies, featuring midstream giants like Sunoco and Energy Transfer. It started in 2010 and carries a steep 0.84% expense ratio, earning it just a 2-star Morningstar rating. It pays a massive 7.55% yield quarterly. The DPS CAGR is negative 3.99%, while the price return CAGR is flat at 0.37%. This is a pure cash flow play. The price doesn't grow, but the yield is a monster. What about the overlap between the three ETFs? It's literally zero. They share absolutely no companies. Buying all of them gives you true diversification across the entire energy timeline. And here is the 10-year price return history of the three ETFs. The orange line is ICLN. This is the exact anatomy of a hype bubble. During the 2020, clean energy spiked over 250%. If you bought the top, you got crushed. Then you have the blue line, XLE. The cyclical giant crashed during the pandemic, but roared back to match clean energy. It is a pure roller coaster tied directly to the price of oil. The purple line is AMLP. It is practically a flat line, sitting at a negative 1.26%. But remember, this is just price return. AMLP is a cash flow machine designed to pay you over 7% a year, not to double your capital. So what about Wall Street prediction for the next 12 months? TipRank's top analysts expect single-digit stability for traditional energy. They see XLE as a moderate buy, projecting a modest 5.7% upside. The pipelines over at AMLP are looking at a similar story, sitting at a moderate buy with a 7% upside. Time for our simulation engine, right? What about being honored to have you as a subscriber too? We are putting $20,000 into each sector for a 20-year horizon, with dividends reinvested and a 15% tax rate applied. First, the hype. ICLN. By year 20, your $20,000 grows to roughly $88,000. But because the yield is so tiny, you are only generating $29 a month in passive income. You paid a premium for a trend, but you aren't getting paid to wait. Next, the dividend machine, AMLP. In year 1, it does exactly what you want, generating over $1,200 in cash. Because the DPS CAGR is negative 3.99%, the payouts are slowly shrinking, and your ending balance is stranded at just $42,000. It is a high-yield trap. It pays you today, but it decays tomorrow. Finally, the cyclical giants, XLE. It isn't flashy, it isn't saving the planet, but look at the math. By year 20, the ending balance crosses $100,000. It beats clean energy by $12,000, and it completely crushes the pipelines. The verdict? When it comes to the energy sector, boring pays best, as XLE is the total return winner. ICLN is a speculation. AMLP is a decaying cash cow. Now, you can stress test your own holdings before you buy. I left a link of the tool in the description. Thank you for watching.